Stop what you are doing. Ignore your previous bias. Scott Bessent just spoke, and if you are holding long US dollar to Japanese yen positions above 157.50, you are standing in a minefield wearing a blindfold. The US Treasury Secretary explicitly stated that excess FX volatility is undesirable, standing shoulder to shoulder with Japan. This is not a footnote. This is not a light comment. This is a verbal bazooka. For 15 years, I have watched how the US-Japan FX dance plays out, and when Washington nods its head at Tokyo's intervention risk, it means the path of least resistance is violently lower. Right now, we have a textbook bull trap completing at the 158.36 resistance shelf. The market gave you one last gasp to sell at a premium. Some of you took it, some of you chased it. If you chased it, I need you to listen closely. The trap is snapping shut. There is one danger zone between here and 158, and one hidden opportunity that could crash down to 155.50 faster than any move up we saw this week. I will show you exactly how to position for a yen wrecking ball, with 3 precise setups, stop losses, and invalidation levels. Stay until the end, because I'm giving out the one level that saves the bulls. Here is your instant market verdict based on this headline. The session bias is aggressive reversal to the downside. We are fading the rip with absolute conviction. The trending structure on the 5-hour chart is a mirage. It is a liquidity grab. The real bias is mean reversion back to the daily 200 moving average. Write this number down. The invalidation level is 158.36. If we close above 158.36 on a daily basis, specifically on a spike driven by US yields exploding higher, then I will admit the intervention threat was a bluff. But if we hold below, and Bessent is the man holding the lid, this market is going to crater. Specifically, a break below 156.16 confirms the bull trap is complete. That is your trigger. Let's narrate the technical deep dive, starting from the top. The weekly chart shows a failure at a multi-decade resistance line. But the daily chart is where the crime scene is. Price is showing a long upper wick right at the 158.36 ceiling. The daily 200 moving average is still way down below, but the gravity towards 154 is real. Look at the moving averages on the daily. The 20-day and 60-day are flattening. They are not sloping up with conviction. This is a classic topping formation. Now look at the MACD on the daily and the 4-hour. Everyone sees the nominal price high, but the MACD histogram is making lower highs. This is negative divergence, and it's screaming that the buying pressure is exhausted. The big funds use this Bessent pop not to buy more, but to unload their inventory to the speculators who think the yen is doomed. They are wrong. The 157.82 level was a temporary support that just failed to hold on the pullback, and now it acts as cement resistance. If we lose 156.16, the next support is air until you hit the demand pocket at 155.87, and then straight down to 155.00. The cross-asset linkage to the Nikkei 225 is absolutely critical here. We cannot ignore it. If this US dollar to Japanese yen move was a true structural risk on yen weakness, the Nikkei would be ripping through 40,000. It's not. The Nikkei is stalling, showing heavy selling pressure. We are seeing a divergence where the yen strengthens, and the Nikkei drops. This is the classic Japan repatriation fear. When the US Treasury talks tough, the carry trade unwinds. The cross-asset message is a blaring siren. The Nikkei is confirming the bearish US dollar to Japanese yen signal. Furthermore, gold has been rallying on geopolitical fear. The Bessent statement implies a desire for dollar stability, not dollar strength. A stable to weaker dollar environment gives gold a bid and crushes the expectations for 160 on US dollar to Japanese yen. The correlation is snapping back to reality, now, the fundamental driver itself. Scott Bessent saying excess FX volatility is undesirable is the key. Why did this change everything? Because it removes the moral hazard of Japan acting alone. The last time Japan intervened, the US was ambivalent. Now Bessent is openly endorsing the discomfort. This gives the Bank of Japan and the Ministry of Finance a free call option to smash speculators. The 1 to 2 week directional lean is heavily skewed to the downside. We are targeting a full retracement of the last week's panic bid. The only event that invalidates this thesis is a sudden, massive upside surprise in US CPI data tomorrow, sparking a hawkish Fed repricing. Or, of course, a close above 158.36. Absent that, this verbal pact is a fundamental ceiling. Most people will skip this segment, but this is where the money is made. Keep watching. Let's map the trade setups with surgical precision. Strategy 1 is the sniper. This is the conservative play. We wait for a 60-minute candle close below 156.16. Your trigger is that breakdown confirmation. Once that support shatters, the market will usually retest it as resistance. You want your entry on a shallow retest back to the 156.20 to 30 zone. Your stop loss sits tight above the breakout point at 157.00, guarding against the fakeout. Target 1 is 155.40, and target 2 is 154.75. The logic here is you are capitalizing on the structural break. The risk-reward on this setup is excellent, approximately 1 to 3. If we do not break 156.16, you do not take this trade. It requires patience. Strategy 2 is the active momentum trader. This setup assumes you want to catch the intraday flush without waiting for the clean break. The Bessent headline often triggers a slow grind lower as the market digests the implication. We look for a pullback into the 60-minute 20 moving average, currently hovering near 157.40. If price climbs into that resistance and stalls, showing a micro double top, you sell. Your stop loss is above the day's high at 158.00. Target 1 is the overnight support at 156.80. Once target 1 is hit, move your stop loss to break even. Target 2 is the range low at 156.16. This strategy utilizes the dynamic resistance of the short-term moving average to catch the momentum shift early. Let's see how aligned we are. Type your US dollar to Japanese yen target for the next 48 hours in the comments. Are you seeing 155 or are you seeing 159? I'm reading them. Strategy 3 is the aggressor. This is the intervention front run. High risk. Zero hesitation. We see the verbal pact as a catalyst. The 15-minute chart is showing a series of lower highs at 157.70. You short immediately on a break of 157.30 with market velocity. Your stop is razor thin, just above 157.85. You are betting that the 157.82 resistance does not get touched again. Target is the crash low at 156.16 for full position liquidation. Warning: this is a momentum scalp that can reverse violently if a headline walks back the statement. Only for those who can eat a loss without blinking. Risk management pulse. Never risk more than 1% on this high-impact news play. Stops are non-negotiable. The spread can widen drastically on intervention chatter. To close. The one critical level for the next session is 156.16. A break there destroys the short-term bullish structure entirely. Tomorrow, I am laser-focused on the Nikkei Open and any follow-up comments from the BOJ. Also, the US PPI data is coming. If you want the full breakdown on why the S&P 500 is confirming this risk-off shift in Bitcoin, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan, subscribe and hit the bell for daily coverage. The trap is set. Let's see how many bulls escape. I'll see you in the next one.